Good morning or good evening, depending on where you are joining us from today. I'm Melissa Zajic. I'm the Executive Director of the Australian American Chamber of Commerce in San Francisco. We're very excited to support this webinar specifically for Australians who are living in the US at the moment and looking for information about navigating finances across borders. Today's event speakers are all Chamber members. For those unfamiliar with our organisation, we bridge Australia and the Bay Area through networking events, informational webinars such as this, and other opportunities to support expats working in the US. We're also very excited to be approaching a huge milestone for our organisation with our 50th annual Australian Gala in February 2026. Our members truly drive the direction of our organisation, and so we encourage anyone in the Bay Area to join us and be a part of shaping the future at the Chamber. So check out our membership opportunities at sfaussies.com. Now to introduce our speakers for today. First up we have James Ridley, who is the Managing Director for APAC for Atlas Wealth Group. James is an experienced financial planner in Australian expat financial advice and recognised multiple times as Financial Standards Power 50 list of influential advisors. He brings a strong background in accounting to Atlas. James has advised individuals, families and businesses and self-managed super funds on a wide range of areas including investment, retirement planning, debt reduction, cash flow management and portfolio management. And James is joining us today from the Gold Coast. Next up we have Tim from OFX. Tim is a financial expert with over 10 years of experience in wealth management and foreign exchange. Since joining OFX in 2021, Tim has overseen the Australia and New Zealand professional services partners. He holds a Bachelor of Commerce and Business, majoring in finance and financial planning, and a Master's in professional accounting. Before OFX, Tim provided full service financial advice, leveraging his expertise to guide clients in achieving their financial goals. And Tim is joining us from Sydney. And last but not least is Tyler Dixon from Spott, Lucey Wall, CPAs in San Francisco. Tyler is also a member of the board of the Chamber in San Francisco. He is our treasurer for the last 3 years. Tyler specialises in tax consulting and compliance services for business and individuals with complex cross-border transactions. Tyler works extensively with high net worth families and their businesses from pre-immigration tax planning, income net tax and foreign disclosure filings to transactional tax consulting to find practical solutions for complex tax issues. So I'll leave it over to our speakers today to share their knowledge with us, and please feel free to jump in with any questions. I believe we may have a Q&A box, or we can open it up to the floor when they're done. Yep. Thanks, guys.
Thanks, Melissa. That was a terrific warm welcome. Thanks, everyone, for joining us today. If you do have any questions as we move through the webinar today, there is a Q&A box, so please drop it in there and we'll do our best to jump into those questions at the end. The session is being recorded, so if you are registered, you're attending, you'll automatically get that recording within the next couple of days as well, and then it'll also be available on our socials via YouTube. So let's move in to today's webinar. Before we jump into it, a quick disclaimer. So what would a webinar be without a legal disclaimer? So to keep our lawyers and compliance managers happy, anything that you hear today should not be construed as personal advice, whether tax, financial, or that related. It should just be construed as general and education information only. If you do need advice and personal advice, please do feel free to reach out to one of the professionals on today's call. A quick plug for the Atlas Wealth Group. We are one of the leading providers of Australian expat financial advice. We specialise in obviously financial advice, cross-border services, mortgages and asset management. We're regulated up to the wazoo by ASIC, ATO, the DFSA, and I'm sure there'll be a couple more initials in there by the end of the year. We've got clients in over 55 countries, managing over 350 million assets, and our specialists are all degree qualified with numerous graduate certifications. Our agenda today will be touching on the currency market update, as well as Tim giving some insight on that track with that big, beautiful bill. And I think a lot of people today are wanting to know more and what we might know about that remittance tax, because I know that's front of mind at the moment. Cross-border wealth planning from myself, and then we'll wind up with some US tax planning from Tyler. We'll now move into and hand it over to Tim to kick off our webinar. So Tim, just let me know when you want to move over to the next slide.
Yeah, thank you, James. Appreciate the intro, and thank you, Melissa, as well. I'm probably going to be the same thing with James and Tyler. Not too much time, so I'll have to sort of go very broad strokes today. But as James said, if you do have more questions, put them in the chat, or you can reach out directly. If you mind, just next slide there, James. Okay, so the first thing that I wanted to mention, and this is quite important, I guess, and that is the difference foreign exchange makes. So I'd probably say it like this. One of the biggest risks that you have as an expat will be foreign exchange fluctuation risk. Let's take, for example, if you do live in San Francisco, working there, you might be there for 2 years, 5 years, 10 years. At one time, if you are looking to come back, and let's just say, for example, you do have $1 million US, you've saved up over 10 years, and you've got that in a savings account, you're earning your 4% for the year. What unfortunately can happen if you don't plan it properly or don't really consider all the situations, it's very common if the market moves against you, it can easily move 4% in the matter of weeks or days. And then there's the additional implication of if you're using a bank or some provider where you don't know what their margin or the exchange rate that you're achieving, that's another 1 to 2% that you could be hit with. And so, a year's worth of interest is just gone in a second without proper planning. And I've just got a quick example here. This is actually a client of mine a couple of years ago, but it's just a great example, so I like to use it. In this case, it was actually an Australian looking to move to the US. They needed $1 million US. And at this point, the Australian to US dollar was actually above 75 cents, which today, I mean, a lot of Australians would kill for this sort of rate. What we actually did, of course, OFX, we don't pretend that we know what will happen in the future, but we do know the past and we look at general trends. And so I remember what we did and what I did with my partner network was say, hey, the Australian to US dollar is actually above 75. It's been a very long time since it's been here. If you do have clients with Australian dollars looking to move to US, now may be a good time to look at that. And we had a lot of clients move money. And in this case, the client did as well. If they had waited 3 weeks, it actually would have, it dropped all the way to 71. And so that would have cost them $90,000. And for people that didn't move, there was obviously quite a large implication there. And I just say all that to say, again, we do not know what will happen, but it is very important to be something front of mind consideration and not just at the end, but throughout your time living overseas so that this sort of situation might not occur. James, next slide, please. Okay, and what I also wanted to discuss was, and I think would be quite useful for Aussie expats living in the US, is just understanding what are some of the market moving events. So if you are looking at, and maybe you are quite conscious of the foreign exchange differences, but you might think, what should I be looking at economically that will have an effect on the Australian to US dollar exchange rate? Central bank cash rate decisions is one of the most important things to look out for. And that, the RBA, they meet every month, as does the Federal Reserve, and they make a decision whether they're raising, lowering, or maintaining the rates. Now, let's just take as an example, the current Australian cash rate, I believe, is 3.85%. I imagine that I am a BlackRock investor or any sort of global investor, maybe another government or etc., investing money into Australian government bonds. Right now, maybe I have $50 billion in a portfolio with Australia. I have a risk-reward ratio that I, of course, am looking at, and I think, okay, there's a certain level of risk for the Australian government, quite low, and I'm achieving a 3.85% return. If the RBA comes together and they say, let's raise it by 50 basis points, so now the rate is 4.35%, that risk-reward ratio starts to look a lot healthier because overnight the risk has barely changed at all, assuming nothing else really has happened, but that reward has increased significantly. So what you find is a lot higher investment inflows into Australian government debt and therefore into the Australian dollar, which of course increases demand and strengthens that currency. And so that's basically one of the biggest reasons why currencies have such a large effect cash rate decisions have such a large effect on these currencies. The other two to consider, which are very closely related, and that's commodity prices and the Australian reliance on the Chinese economy. So for those of you who do not know, China is one of the largest, is actually the largest importer of Australian raw materials. And so if there is poor news coming out of the Chinese economy, that might affect the amount of iron ore and other raw materials that they'll be buying, then what you usually see is a deflation in the Australian dollar. And that's the exact same with commodity prices. There's usually somewhat of a correlation between the price of iron ore and the strength of the Australian dollar. Next slide, please. Great. So yeah, as I mentioned, we really want to avoid this last minute hope strategy. Look, some clients that I'm working with, they do get very lucky, right? And when they want to move back their US to Australia, I was working with a client, I think it was about a month or so ago, that did achieve very lucky, like the absolute top of the market as $1.67 or something, and it was only there for a day or two. Now that has happened in a blue moon, but it is very, very rare. Much more likely people are unfortunately impacted the other way. And by the time they decide to move back to Australia, they now have quite a large sum of assets in USD, and they are forced just to move it at the time. And if that rate is bad, well, unfortunately, they just have to take the hit. And that really is what we want to avoid. And so a couple of strategies, dollar cost averaging, quite a few clients like to use this. And it really just takes the risk off the table, right? Rather than moving back, let's say you're $500,000 US in one lump sum, you might say, okay, I know I need to move back, or I want to move back in 1 year. And so every 3 months, I might move a quarter of my funds. And that way, you just average out the rate and so reduce your risk. Limit orders, another very important tool that we use. And that would be a situation where if you bought equities and stocks, it's exactly the same sort of way. You might say, the current US dollar Aussie rate right now is around $1.53. I'm not super happy with that. I think I can achieve $1.55. What we can do is we can set a limit order. And so that actually we book an order into the market where if the exchange rate hits a rate that allows us to buy it at $1.55, that will automatically trigger for you as the client. The good news there means that you don't need to be checking the rates 24/7. You know that if that happens, it automatically will trigger. We will send you an email saying, hey, client, your rate has been achieved for the amount that you would like. Please send us the funds when you're available. And so that's just a really good way to be able to achieve a better rate than now. Of course, the risks are that, in fact, the rate will slide and go the other way. And then, at some stage, perhaps if you really do need to move it, you will just need to take the market rate. Or another risk, and it is important to consider this, if you set 155, but then overnight the rate actually jumps up to 160, unfortunately, you have locked it in at 155, just as if you bought a stock in the same way. And so you might miss out on potential upside as well. And then the third strategy, which I want to spend a little bit more time on, is forward exchange contracts. So James, if you don't mind, just the next slide. Okay, so a forward exchange contract, I thought best to just describe a situation because this can be very, very valuable for a client in these sort of circumstances. Now, imagine that you are moving home in 6 months, and imagine today is January 1st, 2025, so earlier this year. You sort of have two ways in which you could try to approach this, using a spot or just a transfer at the time. Now, in this scenario, I haven't written it down here, but imagine that you have $1 million US of assets. However, half of that is tied up in perhaps a house sale or a term deposit, which matures in 6 months. Or you could say the house sale is due to settle. It's a very long settlement, 5 to 6 months. And so you know you will be getting that amount of money, but you do not have access to it right now. So the first thing you could do is just exchange the first 500 at the current rate at the time, which was 162, which would result in 810,000 Australian. and then sort of really just sit and wait and hope that the rate improves, and then at that time exchange. Now, if you had done that in this case, unfortunately the Australian dollar did strengthen in these last 5 months, and so you would be worse off. And so you'd only achieve 1.53, so 765,000. So in total, you're achieving 1.575 million. Now, this would be a perfect example where if instead you say, what is this for? Let's discuss this. The option available to you is, instead of the first tranche would be the same. So you have the money, you exchange it, you get your 810. But instead of just sitting and waiting, you would say, okay, I would like to lock in a rate based on today's rate, but I don't want to fulfill the contract. I don't want to actually send the money because I don't have access to it for 5 months away, 6 months away. At OFX, we can book it in up to 12 months. I'm not sure about other providers, but it probably will be very similar. And so let's say that you do that, you lock in a rate. Now, it won't be exactly 162 because you do have to take into account forward points, but I won't go into that here. If you do want to know more information, we can speak about it later, but it'll be very, very close to 162. And so you lock that in as well. And then depending on the type of client, there may be a small deposit required that's fully refundable, but just whatever provider, whether it's OFX or any other one, they're very likely wanting some sort of assurance. And then after 5 months, we would exchange it at that predetermined rate. You send the money to you send the US dollars to OFX. We would exchange at that rate and you achieve the 1.62. And so in this particular case, you would actually achieve an extra 55 grand, which is substantial. But what I just want to be very clear about is that might not always be the case, right? So in 5 months' time, the rate might actually improve and you might be worse off, right? It might have gone to $1.70 and you would wish that you didn't put the forward contract in. So ultimately what you're doing here, though, by locking a forward in, is saying, okay, it might go down, but I know I want the peace of mind. I want the certainty. I want to know what rate I'm getting ahead of time. Perhaps, you actually need a minimum of 1.6 million to buy a house in Australia or something like that. If that is the case, you're taking the risk off the table, and you might be better off or you might be worse off, but you're just you're adding that certainty there. So yeah. That is forward contracts. Again, there's quite a bit more to discuss, but I'll leave it for now because we will get on to the last slide, which is talking about that proposed US legislation. Yeah, so this sort of has, I feel like with a lot of the things happening in the US at the moment, come out of nowhere. But this proposed US legislation, it was passed on the 22nd of May in Congress. It was just passed by one vote. This is a big, beautiful bill, as Trump coined it. And one part of the bill, what we're going to be speaking about, is this proposed. It was originally 5%. It does seem to be amended down to 3.5% tax on outward remittances. From my reading and understanding, what they're really trying to target is expats, and specifically, it seems to me there's quite a few specific nations that they're trying to target. Expats coming in, earning money, and then sending it back to their home countries. And so this tax does not apply to US citizens. It is non-US citizens, which I assume many people on the call would fit into this category. And so what the situation looks to be, if the Senate does approve this bill and doesn't change any of the amendments, it does seem like come January 1, 2026, there will be a 3.5% tax put on all outward remittances, which will be taken by the remittance providers. So, OFX or the bank or any other remittance provider will be required by law to take out this 3.5% tax. And for US citizens, it would be taken as well. And then it seems to me that they would receive a refund in their tax return. So, of course, that's quite substantial. I mean, if you obviously have $1 million plus, that's $35,000 right there. The important thing is, at this stage, we don't really know what is the case. Will it pass the Senate? Will there be amendments? It seems like, from my reading and understanding, because there is a Republican majority Senate, it does seem maybe slightly more likely than not that it might pass, but will that be in its current form? That is something we'll have to wait. July 4th is the date that they're pushing for, so that's the date to look out for. but it will be when the Senate votes on this big, beautiful bill. Once that happens, if that gets approved in its final form, the other unfortunate reality is it's very likely, even after the Senate votes on it, that we won't have all the details because it usually is not the legislative branch of government that talks about all the minutiae of these laws. It is the executive branch. And so what we would find is probably in the next 3 to 6 months after that, a lot more of the details around will it affect me, how will it affect me, how do I sort of mitigate my tax burden here. But all in all, the two dates that are quite important is after July 4th, and then if it does get approved is January 1st, 2026. And I think that is me.
Thanks for that, Tim. That was terrific. Yes, I think a lot of people are on the call for that remittance tax and what it means because it has really crept up. I'm be very curious later in the year to probably get you back on, Tim, to see what OFX is doing for the 3.5% withholding tax and I guess the flow-on impact on the US dollar as well. You know, what that's going to do to the currency because it's really disincentivizing people holding any US dollars, to be honest, because it's immediately discounted. So I'm sure a lot of people on the call repatriating back in the next 12 to 18 months thinking, do I pull the trigger now? Do I wait? So we'll know very soon based on where that legislation goes. So keep an eye on it. We'll be providing plenty of updates on the socials as well. Okay, I'll jump into my slides. I've got a little bit to run through today because I just wanted to try and squash in what I think is the nuts and bolts for managing your finances when you're first leaving Australia and then you're in the US, which will tie in well with some of the things that Tyler will talk about from a tax planning aspect. I wanted to start with a lot of the common mistakes that we see when Australians first move overseas. So these are probably some of the main ones. So deemed disposal, it's often an opportunity which is missed when a lot of our clients have moved overseas. And deemed disposal is the process of paying a little bit of exit tax on things like direct shares that you might already previously own in Australia. But shares back in Australia when you're a non-resident are actually a tax-free asset. However, if you do not opt into deemed disposal, they become actually a very taxable asset by the ATO as well as the IRS. So making sure you obviously look back and see whether you could have benefited from deemed disposal when you first left Australia. And if you've only just moved overseas into the US in the last 12 to 18 months, this opportunity might still be in your wheelhouse. But it just means that you're resetting a diversified, say, share portfolio that you already own in Australia to being tax-free whilst you're a non-resident. A little bit of exit tax on the capital gain up until when you exited Australia, but going forward, you can use that portfolio as a vehicle to build your wealth in a very tax-efficient manner using, as Tim put it, sending money back to Australia via dollar cost averaging, breaking up that currency risk a bit more, but at least you're putting the money to work in a tax-efficient way. Another one, setting up accounts as a tax resident and using family members' Australian address once you've moved overseas and you become a non-resident. So there's a couple of issues with this. Probably the main one is you're putting your tax residency at risk because the ATO gets all this data from financial institutions in Australia and they'll be looking at accounts where you've set yourself up as an Aussie tax resident, but you might not be coming back to Australia for maybe 5, 10, 15 years. So you don't want to ever put that in jeopardy because often if you're moving over to the US, ideally the tax rates, I mean, probably state of California is probably not a good example with the state tax, but other states with some of their state taxes or none, I should say, a little bit more lucrative compared to the Australian tax rates. Obviously, next time if we're doing one to Texas, that'll land a bit better. But the other one would be no withholding tax is being applied to any of the dividends or income distributions because the financial institution you're using as we're down as an Australian tax resident, that can create a withholding tax issue and you can actually have a ballooning withholding tax account back in Australia, which can also attract general interest charges if you're someone who gets quite lazy with taking care of their tax affairs and letting that blow out a couple of years. So make sure these things are done correctly from the get-go. Holding the same type of investments and probably maintaining the same kind of investment strategy. I think Tyler echoed this a little bit, but this is mainly drilling down on what we call passive foreign investment companies, PFICs. You know, they are kryptonite to any Australian moving over to the US or any US citizens living in Australia. just because they attract a much higher rate of tax. You're paying tax on unrealised growth each year, so making what we call mark-to-market elections. And it's very common that when a client might come on board before they leave, they've been using a robo-advisor, investing in some ETFs or managed funds back in Australia. But those are the type of investments that you typically shouldn't have when you move over into the US, just because they'll attract a higher rate of tax, plus a lot of extra tax admin, a lot of forms to complete, which racks up your accounting fees as well. And then lastly here, paying off the wrong kind of debt. So that might seem like a bit of a funny one, but when you're a non-resident, and if let's say you've got a main residence back in Australia that you're going to rent out, and then maybe you've got the capital to pay off the debt, or in the first couple of years you pay off the debt whilst you're in the US, just bear in mind that that could have two impacts. One, there's a concept called loan rebasing in the US where you can actually trigger an inverted currency gain or currency loss, which would be taxable by the IRS. Hard for them to track, but it is actually a thing. The second one is that your non-resident tax rates are quite punitive in Australia. They start at 30%, no tax-free threshold. So it's not a bad idea to have some sort of debt or investment debt on your assets. If you're holding the properties at, say, a neutrally geared position where income is, I suppose, equaling the tax deductions, means you're not inheriting that additional tax of 30% on the rental income, and then maybe you're gearing all your other surplus to retirement assets, investment assets to keep accumulating your wealth in a tax-efficient manner. Tax-effective investments, so PFICs, so probably the most common issue we come across with a lot of Aussies moving overseas. So if anyone on the call that hasn't heard of what a PFIC is, or a passive foreign investment company, if you typed into your browser of choice search and just typed in PFIC issues, there'd be a whole suite of thousands of articles which would deep dive into it. But if you're trying to understand what it actually is, it's essentially any foreign company or trust that has 75% or more of its gross income is passive in nature, or 50% or more of its assets produce passive income. So when you look at that from an Australian aspect, that's any Australian exchange-traded fund, or index fund, Australian managed fund, a real estate investment company, real estate investment trust, listed investment company. Sometimes it can even be a family trust back in Australia as well that maybe you've kept, but you didn't redesign it or detach yourself from it and structure it correctly. So you need to be really mindful of that, because they can be a bit of a tax bomb when you first go overseas. I've seen a lot. I think the worst one I've seen when a client came on board, they'd been in the US for 18 months. They had about 24 Australian managed funds in their portfolio. They'd only been there for 18 months, and the plan was to stay long-term, 5, 10, 15 years. So we had to unwind it very quickly because their accounting fees were quite high, because there's a lot that needs to go into each individual form, 8621 there, but also the tax that they were starting to pay on the unrealised growth in income was quite severe. So removing or ridding yourself of those kind of investments is really important. We do run our own portfolios, but we run them in a US sympathetic manner, using direct shares, US domiciled investments as well, to get around the whole PFIC issue. US retirement accounts, a lot of those that are on the call will have these, but I wanted to just go into a quick 101 of what they are and why you should pay attention to them. So right now in Australia, I suppose myself and Tim, we get the benefit of 11.5%, maybe more, going into our super funds from our employer. If you're not opting into a 401k and using the matching scheme from the employer, it's very likely no one else is putting anything away into a super fund or a retirement account. So a 401k is employer sponsored. You're given the option usually to opt into it. It's not always compulsory. And if there is a matching scheme, you absolutely should, because it's free money from the employer. There's always a concern around how is it going to be taxed when I come back to Australia. So I'll go into that very shortly. But when you look at just, I guess, the basics of a 401k, you have the option to choose the investments. Money that's going in is tax deferred or pre-tax. It grows tax-free in this environment. And then when you start pulling money out, you start paying your normal US marginal tax rates on the pension withdrawals from your 401k. It's a tax-deferred account. If you pull it out early before 59.5, you do cop that 10% penalty tax on top of your US marginal tax rates. Naturally, there are contribution limits as well. A traditional IRA, similar to a 401k, but it's not employer-sponsored. It's something you set up on yourself if you're eligible, depending on your income level. You can make some tax-deferred contributions, claim some tax-deductible contributions, same tax treatment. in terms of withdrawals. And then there's a Roth type of account. There's a Roth 401k or a Roth IRA. That is all contributed to with after-tax dollars. So it grows in this after-tax or tax-free environment again, but later in life when you're retired and you start drawing income from it, it's then tax-free from the IRS. Bearing in mind that the ATO does not acknowledge the difference between a Roth account or just a traditional IRA or 401k, treats it the exact same. So often a question I get is, well, what's best? What should I be working on or growing? Should I be doing a Roth or should I be doing a 401k? It really depends on the intentions and how long you might stay in the US. I think if you've got an employer that offers a 401k and they do a matching scheme, that's free money that you're leaving on the table. So it's always important to take that free money and opt into that because the tax rate will be the same by the ATO, which I'll go into right now. So taxation of these accounts. So let's look at it from both sides. So let's assume that you've grown a 401k for 5 to 10 years. You've come back to Australia, still too young to withdraw it, you're under 59 and a half. But then when you reach 60, you want to start drawing down on it. So the way the ATO looks at these accounts is it treats it as a type of foreign trust or foreign investment trust. And that's the reference there to that Section 99B Income Tax Act of 36. Quite an old tax act as well. It's the one that our tax residency rules are covered in. But the way that the ATO looks at it is there's two components of your 401k or your IRA. And it's the same with the Roth as well. There's the contributions that you've kicked in and that your employer's kicked in. So they make up what we call the corpus. That's the tax-free component. So you're not going to pay any tax on that component to the ATO at all. The other component is the growth. So the investment earnings, unrealized capital appreciation of the investments, income distributions. So that obviously grows over time. When you start taking a withdrawal from this account, very common that the 401k provider will withhold tax, anywhere from, I would say, 20 to 30%. Sometimes we can lodge a W8 bend form to reduce that withholding down, but it is hit and miss in our experience with the platforms. We've had some good outcomes and we've had some rubbish outcomes, and it's all due to the platform. I can't really go up against them, unfortunately, because they take on the risk if they're not withholding. Now, when you migrate those funds back to Australia, the ATO will look at those funds and your accountant in Australia will need to identify what is growth and what is corpus. The corpus amount does not go in your tax return. The growth amount does. And any tax that's being withheld on the US side, you do receive as a tax credit, a foreign tax credit on your Australian tax return as well. Unfortunately, the ATO has no issues with taxing us. And then because our tax rates are a little bit severe, there's usually a little bit top-up tax as well. On the US side, if you're residing or living in the US, then the withdrawals are just taxed at your normal US marginal tax rates. So, you're tiering tax rates there because it is a tax-deferred account. For those that are dual nationals, Aussie, US, I'm sorry to hear having to put up with the IRS for the rest of your life, but that's okay. There's ways to still navigate that space. Your income on those is just taxed as ordinary income, but remember you are getting a tax credit for that amount on the Australian side, so that's okay. It does require just a bit of tax planning with what you're drawing down each year as part of your retirement. I'll move into do's and don'ts. So I thought I'd put these in here just because this is just some quick tidbits here. But the first one here is taking your financial and tax obligations seriously. So this applies both in Australia and the US. So in Australia, very common that we don't do that final tax return. We don't deem ourselves to be a non-resident. We let that blow out for 5, 10, 15 years. The worst one I've seen is 22 years. And they had a couple of investment properties as well. So there's a big tax bill at the end. But making sure you declare yourself as a non-resident correctly, you do some tax planning depending on your asset profile when you leave or before you leave. And then that way you can manage those tax affairs much easier as time goes on. But then also when you get into the US, making sure that you're doing everything correctly from your tax reporting. We come across a lot of expats which just enroll and use your TurboTaxes and those online filers, but they're not really giving you any tax advice, especially if you've got complex assets back in Australia, PFICs, family trust, maybe a self-managed super fund. So being very mindful of how those things actually need to be taxed and treated and covered off with the US. So don't stick your head in the sand with that one. Structuring your super, so it is sympathetic to the way that the Irish treats Australian super accounts. Tyler will jump into this a little bit, but obviously the way that their tax is very different. And the way that you invest within your super can also have a negative impact on you as well. And that's more alluding to PFIX. A lot of the time with our Australian superannuation system, if we're in a retail super fund, an industry super fund, we're in a balanced option, a growth option. That's actually a unit trust that you're investing your super in. You'll be allocated units, all the money's pulled together, and it's all invested as per that investment strategy. So depending on how your super is actually taxed, that inadvertently can be a PFIC. So you just need to be mindful of that as well. Build wealth tax effectively in both countries. If you're unsure about where you might retire, really common question, where should I be focusing on? I'm unsure. Am I going to stay in the US or I'm going to stay in Australia? And that's normal, especially if it's just your first couple of years over there. So take a hedge, do a bit of both. If you know that you're firmly going to repatriate and retire in Australia, then most of your wealth should be accumulated back in Australia and using that dollar cost averaging on the currency over that lifetime of you being in the US. Very sensible rather than, as Tim put it, hoping at the end, and going, okay, what's the currency when I come back? Oh shit, that's 70 cents, excuse my French, rather than the 62 cents. So just being mindful of that and taking, a bit of a moderated approach to that. Being mindful of property taxes in Australia. Yes, big one. So the main residence exemption back in Australia does not apply to you if you're a non-resident. So most people that are on the call, they're in the US right now, are likely non-residents, an assumption there. But that means if you're selling your old main residence that's been rented out for 2 or 3 or 4 years, that's actually going to be taxable by the ATO compared to someone that, like myself, if I sell my main residence because I'm an Australian tax resident, that's a tax-free transaction for me because I've only ever lived in it. I haven't rented it out, but I'm an Aussie tax resident. So there's changes in taxes on property when you become a non-resident, both from the main residence exemption, the capital gains tax discount concession, and then unfortunately, most non-residents, when they sell, say, an investment property, they also get caught by what's called the foreign resident capital gain withholding tax provision. That can be varied down if some calculations are done and a clearance certificate is submitted, but it's just something to be mindful of. Some planning can be done before a property is sold. And then last one, when reviewing any investment opportunities, just ensuring that nothing is going to be classified as a PFIC. That is something that can really blow up your portfolio without taking due care. Managing your finances, don't stick your head in the sand. Don't not lodge your tax returns and come back later and say, I'll sort it then. Come back to a nasty problem. The world is becoming a very small place with FATCA and common reporting standards. It's becoming a lot harder, I guess, to hide things from all of the taxation authorities. Data feeds are catching up and things are shared. So being mindful of that and lodging it accordingly. Don't ignore your savings. No one is putting away 11.5% or 12% into your super if you're living overseas and your US employer is not putting anything away, say in a 401k, because maybe you don't have the option. So that means you're already at a disadvantage to your colleagues back in Australia. So it means you need to be more. You need to be saving. You need to be investing, growing your wealth in a tax-effective way. And couldn't agree more with Tim, currency risk. It is one of the biggest risks to an expat's, I suppose, plans, career, wealth accumulation. So as Tim said, there's ways that you can address that and manage that going forward. So make sure you process those. So when you come back, you don't have anything to show for it, or ideally when you come back, you've got a lot to show for it, which is often the case when we see with our clients. That's it from me. Right, a squash forward in that one. I'm now going to pass it over to Tyler to kick us off on the US tax.
All right, thanks, James. And now we're going to go into everybody's favorite topic, or probably their biggest headache, is US taxes. And, US taxes are complicated when it comes to just domestic issues, and even more complicated when it comes to any sort of international transactions or cross-border issues. And so we're going to try and cover some of what I think are the most important issues to be aware of if you're an Australian living in the US, but we won't have time to go into detail of everything. So let's kind of go to the next slide, please, James. And I always like to start with just a definition of, who is a US tax resident, because we'll see in a moment, it really makes a big difference in terms of how you're taxed in the US. And so the first kind of step whenever somebody comes into the U.S. is looking at, are they U.S. tax resident or are they still a non-resident? And usually it's best to start doing your tax planning before you become a resident, because there are certain opportunities that you can kind of only take advantage of before you become a U.S. person. And so we have kind of three broad categories here of who's taxed as a resident in the U.S. for income tax purposes. And so those are, the first two are kind of obvious, right? If you're a U.S. citizen, you're taxed as a resident. If you have a green card, you're taxed as a resident. And just to point out there, it doesn't matter if your green card's expired. If you haven't officially given it up, you're still taxed as a resident. So it's a common mistake I see is people will move back to Australia. They'll just let their green card expire. That means nothing from a U.S. tax perspective. You're still taxed as a resident unless you've actually relinquished or have it revoked. And so be aware of, if you get a green card, don't just ignore it. You have to go through a process to give it up. And we'll talk about later, there could be some implications upon giving up the green card. And then the last group here is a little bit more complicated, but it's what we call the substantial presence test. And so that you'll also hear referred to as a physical presence test or a 183-day test. And it's based on the number of days that an individual is physically present in the U.S. over a 3-year period. And so the calculation is 100% of the current year days plus a third of the first prior year days plus a sixth of the second prior year days. So you do a bit of math over a 3-year stretch there of days you were physically in the U.S. and you compare that to a 183-day threshold. And if you're at 183 or more, by default, you're generally a U.S. tax resident. There's a whole list of potential exceptions based on tax treaties or closer connection to a foreign country or certain visas that are exempt from counting days. But just kind of looking at the general rule today, you do the math and you compare it to that 183 days. And so any one of these three are triggered, you're considered a resident for federal tax purposes. And then I just have a note here that you also have to consider state tax residency. Won't go into today. We have 50 different states. Most of them have an income tax. None of them can agree on who's a resident. So you have to look at the rules for whatever particular state you end up being in and determine, are you a resident of that state? Next slide, please, James. And so next we can kind of take a look at, okay, why does it matter if I'm a resident or not? And so we'll start with non-residents. And so non-residents in the U.S. are only subject to tax on their U.S. sourced income. So think of, wages from work that you physically performed in the U.S. If you have a self-employment activity, maybe you're doing some consulting and you're in the U.S. If you have a rental property that's physically here in the United States, things like that would be subject to U.S. tax as a non-resident. But we won't care about your foreign sourced income, your Australian investment income, your Australian rental property while you're a non-resident. Further, you kind of have to, as a non-resident, break your income up into two kind of broad categories. One is what we call ECI, or income that is effectively connected with a U.S. trade or business. So that's things that are like your wages from a U.S. employer, a trade or business that you're conducting in the U.S. Could be you're investing in a partnership here in the U.S. that is having a trade or business in the U.S. And that type of income is taxed at our graduated tax rates here. So you look at your tax brackets, you look at your taxable income, and you're allowed certain deductions to offset that income. The second kind of broad group of income is, the technical term is FDAP income, which really is kind of your passive types of income. So think your interest, dividends, sometimes rents and royalties fall into this basket. And that's the type of income that generally in the U.S., if it's considered U.S. sourced, it's going to be subject to a flat rate of tax. 30% is kind of the statutory rate. We do have a treaty with Australia that often reduces that rate. So for example, dividends might be subject to a 5 or 15% tax depending on the circumstances. Interest, I think, is 10% under the U.S.-Australia treaty. So you always have to kind of look at the treaty and see, can you reduce that rate? And I think James mentioned before, there's a form WABN that you submit to your financial institution to get that lower rate of withholding. And then the other kind of big thing here for non-residents is there's no disclosure requirements for your foreign assets and activities. And so that's a really big thing, and we'll talk about in a couple minutes why, but let's move on to the next slide and look at taxation of residents. So just kind of really big picture here, right? Your residents in the US, their tax on worldwide income doesn't matter where you're earning it. It's going to be subject to tax in the US. We have things like foreign tax credits that help reduce double taxation, but kind of as a general rule, all income, no matter where it's earned, is going to be subject to tax if you're a resident. And then second point here is, there's full disclosure of your foreign assets and activities. And so let's kind of move just kind of right along to the next slide, and we can look at what some of those foreign assets are. So I put together here kind of a list, and this is not all encompassing, but these are kind of the most common assets that we see with Australians living in the US. Starting with the first one, foreign bank and financial accounts. So, almost every Australian living in the US probably still has some sort of foreign bank savings account, superannuation account, investment account still over outside of the US. And so those types of accounts require reporting on potentially two different disclosures. One is called the FBAR, or the Report of Foreign Bank and Financial Accounts. And that reporting is triggered if you have, in aggregate, more than $10,000 in the maximum value of all of your foreign financial accounts combined. And the other one is Form 8938, which is filed with your tax return and kind of includes all of those foreign financial accounts plus some additional foreign assets. Has a slightly higher threshold, but both are usually required. When you have one, it's likely you have the other as well. The second one here is foreign rental properties. And so this is a somewhat newer kind of guidance from the IRS, but a lot of times foreign rental properties are what we define here in the US as a foreign branch or a qualified business unit. And so they're treated kind of similar to a disregarded entity in the US, and they require disclosure on Form 8858. Next, we have kind of any sort of ownership in a foreign entity. Generally, if you trigger certain ownership thresholds or you have certain transactions with them, there's going to be a disclosure. And so disregarded entities, foreign partnerships, foreign corporations, they all have their own disclosure forms. And generally, kind of the rule of thumb is if you have more than a 10% interest, you probably have a filing. But it's a bit more tricky than that, because usually people are only considering what they own personally. But the US often drags in what your parents own, what your siblings own, what certain related parties own. And so it really takes some kind of evaluation to see what is your ownership for these disclosure purposes, and do you have these filing requirements. The other kind of main thing to consider here is the US is very concerned with all these things, with US residents kind of hiding money offshore or deferring taxes. And so a lot of these types of investments, there's punitive tax rates or there's special tax rules that prevent the deferral of income or increase kind of the tax and interest calculation when you do take distributions from these types of investments. And then foreign mutual funds. So James covered that on the PFIC topic, but again, if I could talk to everybody before they came here, I'd say get rid of all your PFICs. They're not worth it unless, it's an amazing investment. You're going to pay a lot in accounting fees to do all this 8621s. You're going to be taxed at a high rate. Just simplify your life, invest in other things. You can get US ETFs and mutual funds as well that track similar investments. And so simplify, get rid of the PFICs if you can before you get here. And then lastly, we have, foreign trusts, any sort of involvement with a foreign trust. I know Australians love their family trusts, their discretionary trusts. And so it's always good to review those structures before you come to the US if possible. If you're already here, have somebody take a look and see how you should be disclosing them, but often it's a Form 3520 or 3520A, depending on how they're classified for US tax purposes. And then receipt of foreign gifts and inheritances, that's another one that's commonly kind of forgotten about. There's no tax here in the US if you receive a gift or inheritance from a foreign person, but there is a disclosure requirement on a Form 3520, and if you don't disclose it, you can be penalized up to 25% of the amount you receive. And so it's really important to get that disclosure done accurately and on time to avoid those penalties. Okay, so let's go to the next slide, please. And I just wanted to kind of separately talk about superannuation accounts, because I work with a lot of Australians in the US, and almost every single one of them has at least one superannuation account. And so it's one of the areas where I often see people kind of mistreating them from US tax purposes. And in the US, we really see this as a foreign pension, and so we have to kind of classify it under our US system as one of two types of trusts. One is what we call an employees trust, which is kind of similar to our US 401k. And so an employees trust is generally one where more than half of the contributions have been made by the employer, and the employee is either not highly compensated, or if the employee is highly compensated, the plan is what we call a broad-based plan. And so usually kind of the key deciding factor here from an Australian super is we look at, who made most of the contributions. Was it mostly contributions by the employer? If so, it's likely going to be this employees trust. Kind of oversimplifying here for the purpose of time, but the employees trust is really what you want it to be treated as in the US, because you get tax deferral until you take a distribution, or there's some sort of a rollover that we would see as taxable in the US. It doesn't get you out of all the reporting requirements, though. You still have to put it on your FBAR, your Form 8938, your Form 3520 if you have a distribution. As James was mentioning, there could be PFIX within there, so you might have to file Form 8621, even if it's deferred. There might still be a disclosure requirement related to those PFIX. And so important to get all those disclosures done. And then the second kind of group is what we call a grantor trust. And so if your super doesn't fall into the definition of employees trust, or it could potentially be a hybrid, part employees trust, part grantor trust, you get this grantor trust treatment, which is basically we see the superannuation account as just like a normal investment account for US tax purposes. So you don't receive any deferral on the income within the account. You pick up your income on an annual basis on your US tax returns. And you have kind of all of the same disclosure requirements as the employees trust, but also you have annual 3520 and 3520A filing requirements, because we see this really as a grantor trust. It's like it's kind of a transparent trust in the US. Okay, so let's move on to the next slide, please. And so lastly, I'll cover these last ones pretty quick here in the interest of time, but pre-immigration planning, I think, is always important, especially if you have significant assets outside of the US. So I always kind of recommend people, before they set foot in the US, if they can, talk to a tax professional who is familiar with international tax issues, review your kind of assets. As James was saying, dispose of the PFIX if you can, look at your trust structures, look at the family companies that you own, look at, potential assets that you might want to sell to accelerate some gain, or things that you might want to hold on to and sell after you're US tax resident. And, look at things like gifting or potential opportunities to step up the basis in some of your assets. Also, consider when you're coming to the US your immigration status, and do you really want a green card? As I was mentioning before, once you have the green card, you're kind of locked into the US tax resident definition until you give it up, or you take a treaty position, which can have its own kind of pitfalls there. And so, if you're only going to be in the US for a certain period of time, and there's another visa that will accomplish that task to allow you to stay in the US, you might want to avoid getting the green card from a tax perspective. And so, all things to kind of consider as you're moving into the US. And let's go to the next slide, please, which is kind of the opposite here. And so when you're ready to leave the US, and so we have a lot of people who come here, they take a position in the US, and maybe 5-10 years down the road, they decide they're going to go back to Australia to be closer to family, or to take on a new job, or to retire, or they have kids that they want to grow up in Australia. And so, you really have to kind of be mindful of potential tax issues on the way out. And James was mentioning an Australian exit tax. We also have an exit tax in the US. If you are a citizen, or what we call a long-term resident, which is generally a green card holder who's had the green card for at least 8 years, and you meet certain thresholds that we have here, high net worth, a high tax liability, or you haven't been in full compliance with your tax obligations, then you're subject to what we call the exit tax in the US. And it's a very complicated kind of tax system, but just kind of big picture for a lot of your assets, it's treated as though you sold them on the day before you give up your residency. So you pay tax on kind of all of the appreciation on all of your assets right before you leave. And so it can be a big hit in terms of tax. And there's can be planning, if you know you're going to leave, to give up that green card before you hit that 8-year mark, or to do certain planning opportunities to kind of help reduce that tax on the way out. Okay, and then lastly, I'll be quick here so we have time for questions, hopefully, is some common pitfalls. And so just things that we see go wrong often is, not doing those foreign asset disclosures that we mentioned previously, not reporting the superannuation account. So all of those forms that I mentioned previously, kind of the minimum penalty usually starts at around $10,000. And so you could have no unpaid tax, but could get hit with a $10,000 penalty for not filing one of those forms. And so, make sure you're telling your tax professional about all of those investments, make sure they're evaluating and properly reporting them to avoid a big penalty. We've talked about it a lot, but it's important to say again, don't invest in PFICs if you can. Dispose of them before you get here. Help simplify. And then, lastly, just, make sure you do the planning on the way in, planning on the way out, to make sure that you put yourself in the best position and you're not kind of reacting after the fact. So that's all I got today, James.
Thanks for that, Tyler. That was terrific. Some great insights there on managing your taxes. We'll jump into Q&A. I know we're running out of time. We've probably got a bit of buffer just after our time on the clock, but we'll jump into this one from Carl. Carl's asked the question, not sure if you'll be discussing this. Does Australia require a required minimum distribution from a retirement account after a certain age as the US does? So I think Carl's referring to Australian super assets, which is fine. Australian super, there actually is no RMD or required minimum distributions. If you've got other retirement assets, you don't actually need to draw down on your super. You can keep it in there and it actually just becomes an estate asset. It's paid out upon your passing. So Australia does not have any RMD rules on Australian superannuation funds, funnily enough. So it's a good question. So that one's a really good question. I've been seeing Tim's been answering some questions in the background, which has been great. Another one here. Would the new tax apply to Social Security benefit payments back to Australia? So this is on the remittance tax, the 3.5%. Probably depends on the mechanism in which you sending back the Social Security payments. And I know a lot of clients of mine that are retired that are receiving Social Security. It's often being deposited into a US bank account that they own, and then they're doing a currency transfer. So if that's the mechanism, then the currency provider, OFX, has a requirement to take 3.5% on that. If you're a US citizen, you'll get a tax credit or rebate when you lodge your tax return and get it back. If you're not, and if you're a green card holder or a former working visa holder, then the tax would not be any sort of rebate or credit. You just have the withholding tax. If it's sent directly back from into your Australian bank account, that's a good question, because that's something that, as the legislation right now is very grey, yeah, I would think that Social Security would have to withhold the 3.5% tax. But again, these are the things that we are all waiting on to understand, to be honest. So some good questions there. Tyler, this one might be for you and me. Is there any circumstances where clients would keep their PFIX or a PFIC?
I'd say, where I've had people keep it is if they're going to be in the US for a short period of time and then become a non-resident after a few years, they might just keep it and not sell it, do nothing with it for that period of time. They'll have all those disclosures, but the tax issues might not. That might be a situation where you don't make a mark-to-market election. You deal with the kind of 1291 tax treatment, which is also kind of nasty, but for a couple of years you can kind of deal with it, especially if it's something that's making regular annual distributions.
Yep. Yeah, and this probably ties well into the next question. Tyler, another one for you. Can you clarify the tax on unrealised gains of PFIX point? Is it only for non-Australian tax residents? So a bit of a two-parter. Probably get you to answer the first part there, Tyler.
Yeah, so the PFIC rules apply to U.S. tax residents who have anything that's classified as a passive foreign investment company. Exactly how the tax is calculated is fairly complex. Basically, there's a default treatment, which is usually the worst treatment from a tax result, ends up usually about 50% tax on your distribution because there's an interest charge that applies and it gets spread over the entire holding period and you're taxed at your highest marginal tax rate for each of those years. Alternatively, you can make what James was mentioning earlier, a mark-to-market election, which is basically saying we're going to elect out of that default treatment. Instead, we'll recognize as ordinary income every year the increase in value of each PFIC. And so you kind of pick up each year. Let's say you have, a mutual fund that's worth $1,000 year one. Year two, it's worth $2,000. You've got a $1,000 unrealized gain. So you're picking up $1,000 for ordinary income in that year. And then there's a third option, which is a qualified electing fund, which I won't go into because it won't apply to most of these types of investments. It's more for private investments.
Yep. And then the other part of that question was, is it only for non-Australian tax residents? So PFICs are an issue for anyone that has a tie to the US, whether you're residing in the US or whether you're a US national citizen residing in Australia. You've got the same issue. If you've got absolutely nothing to do with the US, you're living in Europe, but you're investing in ETFs somewhere else or managed funds, the PFIC legislation doesn't apply to you because you've got nothing to do with the US except for holding your investments maybe on a platform. So it's only specific if you have ties to the US. That is the main caveat to PFIC legislation. This one I've actually already come across before. Are investment bonds classified as a PFIC? So investment bonds in Australia, there's bonds that obviously are a debt instrument and a debt investment, but in Australia we've got this concept of an investment bond, which is like an insurance product. You invest in it, you invest in for up to 10 years. After 10 years, it's tax-free. Really common to be used for funerals, child education funds, but also just a good way to invest. The bond itself is actually a type of company because it's paying tax each year. So in the eyes of the IRS, they're actually a foreign company or a foreign trust that holds investments which produce passive income. And I've come across this already with some of our other tax partners in the US, and it is a PFIC. It's very rare that we're recommending it to clients, especially when you're a non-resident. So I can happily address that one because I've seen a lot of back and forth in the past on those kind of investment bonds. But investment bonds, in terms of the debt instrument, very different to the type of Australian investment bonds we have, which is the insurance product that we might recommend to some people. Next question. Regarding aliens passing the residency test, can you define who does not need to pay? This might be a two-parter. Who does not need to pay US tax? For example, a G4 visa. I suppose, is there any visas, Tyler, that you've come across which are fortunate enough not to have to worry about US taxes? Maybe someone that's working for the Australian government, perhaps?
Yeah, I guess if we go back to kind of that substantial presence test, there are visas that are exempt from counting their days, students, trainees, certain government officials, diplomats. And so there is still a filing generally to claim that exemption, but you can, under certain visas, be exempt from counting your days under that test and thus be a non-resident, even if you're here more than 183 days.
Great. Yep. And then, Tim, question for you. Could companies like an S Corp send the money back without triggering the remittance tax? If so, would that just create a different income tax burden on the Australian recipient? That's getting quite nitty and gritty, Tim. So that's a tough one there.
Yeah, no, that's right. I did read that. Yeah, I think that is an interesting question because, yeah, obviously an S Corp doesn't pay the corporate tax, and so a lot of that tax burden just does transfer over to the individual. Yeah, I guess the answer is I don't know at this point because I actually haven't seen anything. And even after I saw the question, I was just looking up to see if I could see anything particular to S Corp regarding this tax. And yeah, I think it's just at an early stage where they just haven't given these details yet. But it's an interesting point.
Yeah, absolutely. Question here from Sharon. Can you help give an indication on the size of the exit tax? Oh, that's a tough one, Tyler. For the US exit tax, it depends, doesn't it?
Yeah, the size really depends on, how much your assets are, right? It's a deemed sale of all your assets. And so basically, you have to look at the appreciation of all your stock investments, all your real estate. It's treated like you fully kind of distributed your superannuation accounts, your IRAs. And so, there is an exclusion for up to 800,000. That number changes annually for inflation. In terms of appreciation, it only applies to certain types of assets, though. And so it's really hard to give, an amount without looking at somebody's particular assets. But just imagine you sold everything you own and calculate tax on that is basically what you're in for.
Yep, absolutely. I think it's funny, the exit tax, I think there's 4 types of exit taxes when you go into the branches as well, of all the different types. So it's an interesting one. Another question here, this is a hard one probably for us to address on today's call. It's probably a bit more just going over to personal advice. If we believe the US dollar will fall, plus potential remittance tax, is drawing on a US line of credit to buy Australian dollar investments as a currency hedge reasonable or crazy if liquidating US real estate isn't an option for 2 to 4 years? It's a good question. I'd probably never want to give you or encourage a yes answer, but I would expect the currency will weaken, especially if this legislation runs through, because it's discounting USDs by 3.5% immediately. So you'll see probably a flood on a lot of the currency providers to send money back into their home currencies, Australian dollar, the pound, the euro, a lot of currencies throughout Southeast Asia as well. Some are pegged to the US dollar, so it's not going to really achieve too much benefit there. But I would say that there is benefit in probably sending money back. I think Tim will probably be quite busy if it gets legislated with probably forward contracts, to be honest, trying to lock in exchange rates now as assets become liquidated to send back. And I think one point Tim made, which I think a good sort of segue, or not segue, but a good analogy with the forward contracts. You know, if you've got a house with a mortgage on it and you go to your mortgage broker and you say, listen, I want to fix the rate. I want to fix 50% of my mortgage at 5%, and I'm happy to cop the other 50% at variable. So it's doing whatever the cash rate's going to do over the next 12 months. If you know that you're going to have to send home an amount, maybe just lock in a forward contract for half that amount if you know you're going to have access to that liquidity. That way you're getting some of it, like Tim already proposed, at a rate that you're comfortable anchoring towards, and then taking on the risk on the other side. But it's a tough one to answer that one, but I expect the US dollar to lose value over the next 6 months. Question here. Yeah, Tim, go on.
Sorry, can I just, there's one question I just want to very quickly answer as well, by Rachel, just talking about if you have funds sitting with a US broker and you sell those, you know, maybe you've got E-Trade portfolio and you want to sell that and send the money back. I don't have the answers here, but it is something for probably everyone that does have any share portfolio to really keep track over the next 3 months, that if that is a situation where, you know, they say, yes, E-Trade, Charles Schwab, all of these brokers in the US, they are going to need to withhold the 3.5% tax if they find that if they're sending the money to a foreign recipient, right, your account in Australia, then, you know, but how would the tax treatment be if you have a CBA brokerage account, you know, ComSec, and they're investing in foreign equities as well? Will that be different? Again, I don't have the answer, but it's just something I wanted to touch on, because if it is different, well, that will be a very important thing to take stock of in terms of how you invest in those US equities. I just wanted to touch on that. But yeah, I'm sure I see there's many other questions as well, but obviously all our details are there if they want to ask a specific one.
That's right. Yeah, there's always going to be a lot on this remittance tax that is coming through. We'll know very soon, July, and then obviously they've got to flesh out the legislation a lot more. So might try and focus on some of the questions outside the remittance tax, because we're still in that area right now of grey. So I'm just going to quickly churn through the questions for our viewers, if that's okay. Good one here from an anonymous dual citizen currently working in the USA, planning on retiring in the USA in 2 years' time. What are the tax implications when receiving distributions from Australian super accounts? On the Australian side, they are tax-free if it's a normal pension. And then on the US side, I'll hand that over to Tyler.
Yeah, so if you're a US resident receiving distributions from a superannuation account, they're generally going to be considered ordinary income, taxable to you. There's a potential you have tax basis in it, but normally you won't, because you only have basis if you basically paid tax on gross income that included your superannuation contributions in the past. And in my experience, usually when people are here, they're no longer contributing to their super. And so none of those contributions were taxed in the US. So generally, when you take a distribution, it's going to be taxed as ordinary income. And you're going to have some disclosure requirements here on that 3520, which is important to remember as well.
Yep, good question. There's a little bit here on Australian super and PFIX. So I might talk about Australian super. Australian super, just going to remember what Tyler was talking about, how Australian super isn't really a PFIC, but you might own PFICs. Australian super is a type of trust. In Australia, it's very common when you're in an industry super fund, a retail super fund, Australian super, CBUS, Hester, REST, all of those types, you will have an account. It'll be invested in the MySuper balanced option or the MySuper growth option. You'll own units in that investment option. So because it's a unit trust that you're investing in where your super is placed, and we go back to the PFIC definition, any foreign company or trust that produces, or that 75% or more of its income is from passive means, or 50% or more of its assets produce passive income, it does mean that we are inadvertently invested in a PFIC, yes. Depending on the trust treatment, based on the super and how it's designed, and what Tyler has obviously run through on the treatment of super, that'll obviously dictate the kind of reporting you'll need to do and potential punitive taxes or paying tax on an ongoing manner each calendar year. But very common and very standard that Australian super is just invested in traditional managed funds, LICs, direct shares. Direct shares aren't obviously a PFIC, but it's very normal as part of any investment strategy when an Australian managed fund is investing or a super fund is investing. So some good questions there. I know you're just trying to get clarity. Let's have a look at this one. I'll just keep moving through. A lot on 3.5. We might finish up at Mitchell's because I'm mindful of the time and I really appreciate everyone hanging in there with us today. Is there a minimum amount required for a forward FX contract, Tim?
Yeah, that's a good question. It would depend on the provider. I guess I can only answer for OFX specifically. Generally, we would say for clients, it's around $10,000. Anything less than that, it really is not worthwhile. Yeah, even in many cases, it can be sort of 50 grand, but I think, yeah, if it's a USD to AUD or AD USD, because it's such a liquid currency and it's quite simple in many cases, then $10,000 would be the minimum for a forward contract.
Yep. That might do us for today. I think we've answered all those questions. I know there's a couple there that we haven't touched on, but they are centered around the 3.5 remittance tax, and appreciate everyone's trying to get clarity. Unfortunately, right now we're trying to read from the tea leaves, which is often the case when legislation's running through. Ideally, we'll know more after July and August as it goes to that executive branch where they really break out the legislation specifically. In the meantime, guys, this session has been recorded. You've got our contact details there. If anything else pops up, if you need advice, reach out. And in the meantime, keep an eye on the socials. Try and do more of these webinars coming up, obviously with those big tax changes rolling through in the US. We really appreciate your time. Those in the US, have a lovely evening. Those in Australia, have a lovely day. Tim and Tyler, it's been great having you guys on. Can't wait to do another one.
Thank you.
Thank you.
Thanks,
Thanks,
guys.
guys. Thanks, guys.